Ladies and gentlemen, good day, and welcome to the Q3 FY24 earnings conference call of Ethos Limited. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pranav Sabu from Ethos Limited. Thank you, and over to you, sir.
Good evening, everyone. Thank you for joining us on the Ethos Limited Q3 and 9 months FY24 earnings conference call. I hope everyone had a chance to view our financial results and investor presentation, which were recently posted on the company's website and stock exchanges. I am accompanied by our CFO, Mr. Ritesh Agarwal, and SGA, our investor relations advisors, on this call today. Let me give you an overview of our Q3 and 9 months FY24 performance. For Q3 FY24, revenue from operations is up 22.4% to rupees 281.2 crores from rupees 229.7 crores in Q3 FY23. As I have mentioned in our previous earnings call, there is a shift of the Shraddh period this time from Q2 in the previous financial year to Q3 in this financial year. This led to a muted growth in the October month, and thereby lowering of the revenue and profitability growth of the quarter. However, when seen for 9 months, it is as per the guidance we had given both at the beginning of the year and at the end of Q2. Despite the impact of the Shraddh, 10-day impact of floods at Chennai, and store renovations, we have grown by 13% in October, 26% in November, and 28% in December in revenue. EBITDA for the quarter grew by 28.5% year-on-year to rupees 50.8 crores in Q3 FY24. EBITDA margin for Q3 FY24 stood at 17.7%. This is despite a negative movement in the foreign exchange of CHF and INR. CHF INR was at an average in the Q3 FY23 of 85 versus 93.90 in Q3 FY24, with it ending at 98.88. This led to a margin loss in the quarter, as well as a further direct exchange loss on remittance and reinstatement of rupees 2.21 crores. We believe that the price will be passed on to the customer within the next 3 months, and we believe that this will lead to a positive impact in the coming quarter and in the next year. Our efforts to grow margins were not fully visible this year due to a constant negative movement of the exchange rate of the CHF INR. But we are seeing stabilization of this now, and we are looking forward to a positive future. Since we are talking about EBITDA, you may notice an increase in manpower in comparison to last year. This is because we are hiring early to train people for the rapid expansion of over 25 boutiques in the coming years. In the long run, this will stabilize back to the positions we saw in the previous year. Silver City, which owns our brand Power Luba, also had a loss of 58 lakhs. This is pre-operative in nature. Power Luba is the second oldest Swiss watch brand. We will launch globally in August this year with an absolutely beautiful and stunning 3 collections. We aim to reach sales of 100,000 watches per year over the next 10 years at an average of CHF 2,500 per watch ex-factory price. Our same-store growth in Q3 was 11.2%, which was impacted by the renovations of our store and the Shraddh period. Eliminating the impact of both Shraddh and renovation, our SSG for the quarter stands at 15.3%. Furthermore, as of 9 months FY24, our new client enrollment stood at 88% and also repeat customers stood at 46%. As you are already aware, we have opened our first Remova boutique in Geo World Plaza, Mumbai. From the start, we received an overwhelmingly positive response. The segment generated revenue for around 60 days and contributed to the bottom line. It is already profitable and has been profitable from the first month onwards. Profit after tax grew YOY in Q3 by 23.5% to 25.5 crores. Now, coming to the 9 months, revenue from operations is up by 28.5% to rupees 746.5 crores from 581 crores in 9 months FY23. EBITDA for the period grew by 33% YOY to rupees 130.9 crores. EBITDA margin stood at 17.2% despite there is an increase in our manpower cost on account of future capacity building. Profit after tax was 62.3 crores as compared to 47 crores in 9 months FY23, which grew by 32.4% on a YOY basis. Inventory days as on 31st December 2023 stood at 156 days at sales. Gross debt stood at 6.85 crores as on 31st December 2023. Cash and bank balance stood at 350 crores as on 31st December 2023. Share of exclusive brands for Q3 FY24 stood at 29.3% and 9 months at 30.7%. Revenue from CPO or certified pre-owned was rupees 49.7 crores in 9 months FY24. Before we go for the question and answer part of our discussion, allow me to talk about the upcoming year. We are extremely happy with our talks with brands, and allocations from the biggest brands to the company are greater than what we have expected for the next financial year. We remain confident of our long-term goal of increasing revenue at a CAGR of 25% for this decade. We will launch our app in about 2 weeks' time on 1st of March 2024. This is a small step towards a big vision of giving personalized and customized watch buying experience to our customers. We will build the app slowly but steadily over time to provide customers the next level of information, transparency, exclusivity, and experience. It will give us the data to provide customers exactly what they need. We are extremely bullish that over the next 5 years, the Ethos app will seamlessly integrate with all the services of Ethos, including after sales, lifestyle, CRM, pre-owned, and give Ethos an edge over all other retailers. Provided there are no delays from landlords, we expect to open 25 boutiques by the end of the next financial year, 25 new boutiques. I am also happy to announce that this includes India's largest horological project, which will open in Gurugram and will cover 12,500 square feet carpet area, featuring about 9 boutiques and 2 multi-brand areas. It aims to become one of
Ladies and gentlemen, the line for the management has got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the line for the management reconnected. Over to you, sir.
I'm sorry I got disconnected. Please allow me to continue. I am also happy to announce that this includes India's largest horological project, which will open in Gurugram and will cover 12,500 square feet carpet area, featuring about 9 boutiques and 2 multi-brand areas. It aims to become one of the finest horological projects in the world and will take customer experience to a whole new level. This will put Ethos and India on the global map and assure the allocation that we need for our continued growth and assure that we will continue to get brands on an exclusive basis. Ethos was also recognized as one of the 20 finest retailers in the world by the Revolution magazine, and our aim is to become one of the world's top 3 retailers by the end of this decade. We have incorporated RF Brands Private Limited with an aim to distribute some of our exclusive brands to other retailers who wish to work with us. This is an exciting new area we are developing, starting with the brands under the price point of 1000 CHF. We will start with the brand Maserati watches. We are closely monitoring the development of the free trade agreement between Switzerland and India. We are hopeful it will lead to a reduction in the duty of imported watches. This will grow the market significantly, as it will lead to a reduction in smuggled watches coming into the market, encourage more Indians to buy locally, and encourage more brands to enter the market. It will allow for greater local investments by Ethos and by brands, as both will experience positive margin growth. With this, I open the floor for questions and answers. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Devanshu Bansal from MK Global. Please go ahead.
Yes, hi. Thanks for the opportunity. Pranav, as you mentioned on this news flow around finalization of contours on India-Swiss FTA, I just wanted to check if we take precedence from similar FTAs of Switzerland with other countries. What is the level of margin gains that can accrue to us in case India ends up signing this agreement?
We don't have the full details, of course, but what I can say is that, for example, with Japan, India has a free trade agreement where the duty is lower by about, instead of 23%, it's effectively 5%. So that is one area. In other countries, it's even lower, the duty, where Switzerland has a free trade with other countries. It's about 3 to 4%. But again, of course, this is an open point and one discussed between governments. But we are hopeful that it will lead to a reduction in duties and a positive impact on margins in the future. It will also allow for brands to enter India. Many brands are not able to enter India right now because the duty is prohibitive.
Got it. And this, whatever 15 or 16% additional benefit that we will get, this will be shared between brands and retailers equally, or how is it going to happen?
I think, the logical way is to do it equally. In some cases, it will come to us. In our contracts with exclusive brands, in most cases, it will come to us. In some cases, it will be split.
Got it. And Pranav, you interestingly also mentioned that you expect 25% top line CAGR over the next decade. So wanted to check what is the overall store potential for Ethos watch boutiques that you expect we can add over the next 10 years?
Look, I think that I don't have exactly a number in mind per se, but we will be targeting between 13 to 14% same-store growth during this period. So the others will come through new stores. Now that depends upon different changes in the market, depending upon what is the rest of the distribution, how that distribution is going to be, whether we do larger stores whether we do smaller stores. It's too early to sort of comment on this at this point in time. But what I can say is that the next year definitely we have 25 stores and a similar or 15 to 20 stores in the following year after that. 15 stores in the following year after that. So there is, right now we see immense potential. What I do want to tell you is that even cities that we are opening up like Raipur, etc., right, from the second or third month onwards, they are profitable already. So we see very good signs in tier 2 cities, and that's very encouraging for us.
Got it. Next question is on Favor Luba.
Sorry to interrupt, Mr. Bansal. May we request that you return to the question queue?
Sure, no issues. Yeah.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to 2 per participant only. We'll move on to the next question. That is from the line of Rahul Agarwal from InCred Equities. Please go ahead.
Hi, very good evening, and thank you for the opportunity. Firstly, a smaller question. The billing details for the new watch and CPO are not part of the presentation. Could you share that? Then I'll move on to the logical question.
Last time we showed
Rahul, we present the billing details. So CPO billing details we have already mentioned. Pranav has also mentioned that for 9 months we have 49.7 crore of a CPO business. And in presentation we used to present the overall that has already been there. In case if you have any further questions, we can take offline.
Okay, I'll move ahead then. So on the cash usage, right, 350 crores, just wanted to understand, obviously you shared the store addition plan, so that's pretty clear. But broadly on, if you could share some more color on what is the plan for Favor Luba, that is one, because it looks like a larger investment from our side. And then luggage and jewelry, are these also part of this store addition, which we discussed, 25 and 15 stores respectively for next 2 years?
So next year is 25 stores, but next year we are looking at 25 stores. So I think that we have, the cash usage is for that, for capex and inventory. But I'll let the CFO answer this question.
So Rahul, just to answer you on the second part of your questions about the store opening, including luggage and jewelry. So as in our earlier call as well, we have already mentioned that we are learning the new vertical, especially in the jewelry. So jewelry would be there maybe in a couple of years that we are going to learn and then expand slowly. Luggage, again, it is 1 or 2 boutique, maybe 3 boutique maximum in next 2 years. Majorly, the growth will be in our existing business, which is into a watch retail. That is the prime and that is the growth opportunity that we have. So that will continue to grow.
For just to answer for Remova, for example, we've signed the first one. We're looking for place for the next 2 boutiques. We are hopeful to do 2 more boutiques, provided we get the right space in Delhi and in Bangalore over the next 12 to 15 months.
Anything on the Favor Luba side?
Sorry to interrupt, Mr. Agarwal.
I'll just quickly answer that last one. On Favor Luba, as I said, right now we are in the right now you would have seen a 60 lakh rupee loss or a 58 lakh rupee loss in the Concall. We are in the pre-operative stage right now. Next Geneva Watch Days we will launch globally, where we invite retailers from around the world. We have an overwhelming response right now from the biggest retailers around the world that they want to work with us. Of course, it takes that time to get all the designs ready, all the product has to be put in place. So that is where we have the launch is taking place over there, and in the first year our plan is to sell 3,000 watches, and over the next 10 years is to get to 100,000 watches.
Got it. I'll come back in the queue. Thank you so much. All the best.
Yeah.
Thank you. The next question is from the line of Shivam Shah from SmartSync Services. Please go ahead.
Hi, am I audible?
Yes, sir. Please proceed.
Yeah. Thank you for the opportunity. First of all, congratulations on the super set of numbers, despite the challenges.
Thank you.
My first question is regarding Favor Luba only. So when are you expecting this to be launched?
We will launch globally during Geneva Watch Days, which takes place in the last week of August in Geneva.
Okay. And so what like what were the number of new stores that we opened in quarter three?
We opened one new boutique in quarter three this year.
Okay. Thank you.
Thank you. The next question is on the line of Kunal Sharma from Care Health Insurance Limited. Please go ahead.
Yeah. Hi, sir. Good morning. So my question on demand. So our numbers are pretty impressive. So looking at the current scenario where subdued demand in the consumer discretionary space, right? So actually, I'm asking you on the on-ground thought process. So how are you your HNI customers, and aren't they bothering about the current inflationary environment and prior to buying this such large ticket size of product?
I think our customers are actually celebrating the success of India's stock markets, and Indian businesses around the world are celebrating the new highs that they are reaching. So I don't think that our customers are worried about the long term at the moment, and I think they are spending on items that have heritage, beauty, and that lie on the crossroads of emotion and art and crafts, and again, that's just one part. But even in weddings today, there's such a big celebration that takes place, and watches are a very elegant way of gifting. So we are not seeing any such problem right now. We are very confident about the next year. We are very confident already. The trends for this quarter, we are very confident on where we are going. So we don't see any major concerns from a demand perspective.
Okay. And lastly, and I think it's been more than 3 to 4 months to open up your first store. So the response on that particular store?
Sorry, your voice got cut. Could you repeat that question? I didn't hear the question.
Yeah. So actually, my question was on Remova. So actually, I think it's been more than 3 to 4 months we have opened up your first store on Remova. So what was the response on that particular store?
So Remova, the response is actually greater than what we had thought. It is. We are fighting to get as much merchandise as we can in right now. From the first month onwards, it's profitable, and we are working hard to be able to find the correct location in this year to open 2 more boutiques. So we are very happy with it. Just to tell you what is the challenge about the location is that it needs to meet international guidelines. So Remova has certain international guidelines that need to be met when we sign on to a location. We have identified one location as we speak. In the next week, Remova is going to push it to their board for approval. If that happens, we will open the second one in Delhi, and hopefully the third one in Bangalore later in the year. But we are extremely happy with the performance of Remova till now. In the next year, we want just to give you a little bit of color behind this. We expect each boutique to do about 20 crores of business, and to start with, and then grow from there. That's the current scenario with the Remova boutique.
Okay. So only on the follow-up, right?
Sorry to interrupt, Mr. Sharma. May we request that you return to the question queue?
Yeah, definitely.
Thank you. The next question is on the line of Shreya Jain from Niveshaay. Please go ahead.
Hello.
Yeah.
Sir, thank you for the opportunity. I wanted to ask about the store unit economics of Ethos and how this will be different from other regional players like Kapoor and Simpsons and watches.
I can't really report on how it's different, but I'll let the CFO. I will let the CFO answer this question.
So Shreya, if you have reviewed our numbers, which is already published on the stock exchange about the profitability, that's what we report into a stock exchange. We would not be in position to comment anything about other retailers, that how they perform, because we are unique from the other retailers, especially into the retailing of luxury watches where we do not see any comparison from a listed peer.
Okay. Another question that I had was, when we enter into any exclusive brand, do we also undertake to do the marketing expenditure on our own? What amount do we usually spend on advertising, and how many year long are those exclusive deals for?
Our exclusive contracts are typically between 5 and 9 years with auto renovations, auto renewals that happen. Coming to marketing, typically the marketing is shared between the brand and between Ethos. And typically it will be to the tune of, I'm just giving a typical number, would be about 1% of the MRP each.
Okay, sir. Thank you so much.
Yes.
Thank you. The next question is from the line of Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, thanks for taking the question. I just want to go back to that earlier comment of yours that, you can compound at 25% for the next decade. So if you are at about 1,050 crore, let's say for this year, that implies that you should get close to about 10,000 crore in a decade or so. So I want to understand, how do you see the total addressable market right now in India for watches, and what percentage of market share do we have, and then how do you see that market growing, and then what do we end up with in terms of a market share?
So your question is about where we are going to grow from a market share perspective? Is that roughly the...
Currently, like with our 1,000 crore, let's say, run rate, what is our market share? So, so what is our addressable market in total then? And then how is that market growing? At what rate do you see the market growing?
Right. There's no exact numbers. There's an industry report which shows market shares of different brands. But before we get to that, I want to explain that there are different verticals that we are in today. Right? New watches is one. There's pre-owned, which is adding to it because it adds to the multiple ownership of watches. And there's trading of watches that takes place. That adds to it. Over and above that is the lifestyle business that is also coming into place with brands like Rimowa, and hopefully for Messika we open a boutique as well this year. If we are able to find the right place, we had the right place, but if we had to let it go because the landlord was in litigation with the current partner who's not leaving it. But coming back to that, so these are all the things that will add up to the growth. Today, our market share, I'll let Ritesh, what is the...
So our market share from a luxury side, it's 21% on the luxury retailing as per latest industry report by Technopack.
And my expectation is that over the decade we will grow aggressively and reach 40 to 45% on this.
And when you talk about the market share, so FY28, that's what the Technopack has projected in the premium and luxury segment by 17,400 crore.
Okay.
Remember, market share is also because certain brands are shifting towards us. Like Ulysse Nardin was the latest brand. They were working with 6 or 7 retailers, and they're now starting off this quarter. They are going to be available only with us. So brands are also going to shift exclusively to us, which is a big part of our strategy. If you look at our presentation, it's there that working with brands and bringing brands exclusively is very important for us, because then we are able to invest and also create a moat around our business, create value for the brand and create value for our shareholders as well.
Understood. My second question was on the unit economics. In your past conference calls, you mentioned payback period of about 3 years. And I believe that the total capex, 1.2 crores of capex and about 5.3 crores in inventory, so about 6.5 crores goes in setting up a store. So can you just talk about maybe first year, what is the revenue, what does it get to by the third year, what is the first year margins, and what do they get to by the third year?
I think we can take this offline. We can take this offline.
We've answered this question in the previous one, but we'll do it offline as well. It remains largely the same as our previous calls.
Okay. So then just another question.
Sorry to interrupt, Mr. Doshi. May we request that you return to the question queue? There are participants waiting for their turn.
Sure.
Thank you, sir. The next question is from the line of Omkar from Shree Investments. Please go ahead.
Yeah, good afternoon, sir. You mostly talked about the revenue growth potential in the upcoming decade. Just wanted to know currently the margins which you are doing 17%, around 17.5%. So you talked about the margin expansion, but which you couldn't do fully this year. So just wanted to know your views on what would be the long-term margin you would be targeting.
So, I mean, I don't want to give a number right now on what we are targeting on a long-term basis because it's sensitive. But our margin has been increasing, and we expect that this will continue to increase because of one, operating leverage kicking in. Two, obviously, right now prices in India are factored. Over the last 2 years, over the last 18 months, if you see the price movement of the CHF INR has been extremely unprecedented. We've never seen this over the last 10 years, what we've seen in the last 15 months. That will stabilize and that will also add to it. But over the long run, we want to increase this through operating leverage, our share of exclusive house brands that is selling because we enjoy a much greater margin over there, and of course fully pricing on towards the brand. That's how we are looking at an increasing margin in the future.
So EBITDA margin has already been increased. I can say that 50 basis points from last year YOY 9 months.
Okay. The second question is on the.
If you can list all your questions together, it will be.
Anyway, this is the last question, but in the future we'll ask the person that on the. Yeah, please go on.
Yeah. The second question is on the return on capital employed and ROE front, sir. What kind of figures you are expecting?
So our ROIC is over 20%.
Our ROIC is over 20% today. I don't want to give a number publicly right now at this point of time, but all I can say is that we are very closely tracking return on invested capital. We have processes in place that we have a certain number in mind that we want to try and hit in the future. We are not disclosing that publicly, but I can assure you we are working hard to increase this number.
At least you can sustain and better it. That's the vision, right?
Of course.
Yeah. Okay. Thanks.
Thank you. The next question is from the line of Shalini Gupta from East India Securities. Please go ahead.
Yes. Thank you. Thank you for the opportunity. Now I have two questions. One
sorry to interrupt. Ms. Gupta, can you speak a bit louder? Your audio is sounding very soft.
Can you speak louder? And if you can give me your questions, both your questions up front, then we can answer them.
Yes. My first question is that the CPO revenue, you said the 9-month revenue was around 40, 49 or 50 odd crores. No,
yes.
Sir, when I look at it, that revenue has been the same for the last 3-4 quarters, CPO revenue. So, and on the other hand, we hear all sorts of things that the CPO market is growing in a big way. So my question is, number one, why is it that your revenue has remained the same? And your outlook on the CPO market? That's number one. Number two, what are the volumes that you did during the quarter?
Okay, let me start with the CPO number. I'm not sure where you're getting the number of CPO being the same, but CPO has, from a percentage-wise, what has been the increase in this quarter? What is the percentage increase?
So YOY 9 month overall YOY 35%.
And quarter 3 is even higher than that,
yes,
right? Quarter 3 is 45% increase YOY.
Yes, yes.
It's over 45% over the previous quarter over the previous year. On a YOY basis, quarter 3 is 45% higher. The biggest challenge in going up is how we are different from others is that we want to protect the Ethos brand, and we want to do this slowly and steadily. Every wash that we get, we give a 2-year warranty. We Nobody else in India is doing this. We have a 2-year warranty. We open every watch, we restore every watch, and then we sell the watch. We are now putting up a second service center in India to be in South India. Right now we have it in North India. We're putting it up in South India, a state-of-the-art service center to be able to restore more watches. In the next year, we are looking at another 50% increase, 50 to 60% increase from CPO. I believe CPO will continue to increase. I believe that we have to do it in a steady manner to be able to make sure that we protect the Ethos brand name and we separate ourselves from everybody. There's lots of people today who are doing it on WhatsApp. They're completely non-compliant. From our side, we are working with the government also to get clarifications on the exact compliance required for all transactions that we do, and we err on the side of extra compliance rather than lesser compliance, and those are today the biggest challenges, but we expect this to continue to grow at 50% every year.
The volumes, the number of watches sold.
Ms. Gupta,
Volume is
I asked this question in the beginning only.
Yeah, okay, I'll just do it. A volume, we are seeing a growth. We have, where is the volume number?
So we are growing from volume side. We are growing above 1 lakh price by 19% from last year.
This is 9 months.
9 months.
So just to be clear on this, as you know that we are lowering the price point below 1 lakh rupees inside our stores, and there have been constant questions look, are we increasing volume? So we are sharing the volume that we are doing above 1 lakh rupees. Below 1 lakh rupees, we want to take it into our new company, RF Enterprises, where we will be doing distribution of these brands to other retailers. Above 1 lakh rupees, we have a quantity growth in 3 months of 15.5% and in 9 months of 19.2%. Does that answer the question?
Yeah, the absolute figure, please.
Sorry, we can take it offline.
Let's take that offline. I have the percentage growth in quantity, but I will answer this later. I think it's 6,308 versus 5,462, above 1 lakh rupees for the quarter of 3 months.
6,308. Okay, thank you, sir. Bye.
It's above 1 lakh, yes.
Yeah.
Thank you. The next question is on the line of Pallavi Deshpande from Sameeksha Capital. Please go ahead.
Yes, I just wanted to understand what was the pre-operative employee expense for each of these for the 9 months and maybe for the third quarter that you highlighted. And secondly was on this ASP, there was this decline for this quarter, so just wanted to know. I'll take the second question back. I'll just go back and put my second question as on Favre Luba. What's the kind of profitability we expect, when we hit 100,000 watches, and how much of a lift can it give to the gross and EBITDA margins for the company as a whole? That's it.
Okay, so what were first question? I've forgotten the first question. You'll have to repeat.
Pre-operative for the third quarter.
Pre-operative. We have. I don't have the exact cost with me, so I'll have to get back to you on this. But I have the exact number. It's roughly we are looking at opening 25 stores in the next year. That means we are adding about 6 people per store, so 150 people. Today we have estimated that we have hired 60 people ahead of time to be able to catch up with this and make sure that they are trained well in advance. So for the quarter, we would expect that the additional cost was about 60 lakh rupees for this.
All right. And so secondly, on Favre Luba, we're looking at 100,000 now.
We have it's too early to say about the profitability, but all I can say is that 100,000 watches at 2,500 Swiss francs is a large revenue and of course, because it is our own brand, it will be extremely profitable. One can look at other brands that are as large and see the profitability. We will benchmark against those.
And in India, what would be the share you're targeting from Favre Luba? I see that in the store it's already being showcased pretty nicely and with larger
Actually,
discounts?
that is right now the stock that is there is not the new collection. When the new collection comes in, we're talking about the new collection. This is the collection that when we acquired, this is the collection that was there when we acquired the brand. When we get the new collection, it will elevate it to the next level. The 2,500 Swiss francs is the X factory. So obviously, when it comes to India, you realize that price will be double, right? So that we have to separate. You have to separate brand and retail. Ethos will be the retailer for the brand, which is owned in Silver City. So Ethos will be a large part of it, but by the time you get to 100,000, Ethos will be a large part, but I can't give you the exact percentage. But you just have to make sure that you differentiate between brand and Ethos.
Right, got it, sir. Thank you.
Yeah.
Thank you. The next question is on the line of Saksha from Old Bridge Capital. Please go ahead.
Yeah, hi Pranav and team. Congratulations for a good set of quarter numbers.
Thank you.
Just one question from
Saksha, can you be
Sorry, we can't hear you. You need to be a little bit louder.
Is it better now?
Yes.
Yeah. So just one question from my end. You mentioned that you're trying to kind of re-enter the price point of 1 lakh and below through your new entity, and just wanted to know your thought process to re-enter this category, because we were kind of getting rid of this category till now in our own stores. So your thought process to re-enter, and also when you do this, who bears the inventory risk here? So that's just one question.
Yeah. Thank you. These are very good questions. So just to be clear, Ethos has boutiques under the name of Ethos Watch Boutique and Ethos Summit. Here we want to get rid of watches below 70,000 rupees, right? But we have very close relationships with these brands, and more brands are embracing the professional way by which we do business. So what they've come back and said is that these are typically the non-Swiss watches, right? Like Maserati watches or other watches which are in the 40,000, 35,000 rupee price point. Right? We don't want to put them in Ethos. So they said that, look, we are going to go and get another distributor who will sell in other places where these 30,000 rupee watches are sold. Why don't you do the sales for those watches, right? So then we said, okay, if we are able to get enough brands, it makes sense. We spoke to brands, and all the brands were very happy that we are entering into this. We will go and sell to other retailers who are competing at the price point of 20 to, let's say, 80,000 rupees. There are many retailers who work in that price point. We will distribute to these. We will hold 2 to 3 months of inventory, and then we will be giving it to those retailers. We will not be giving it to those retailers on consignment. Those retailers who buy from us will bear the inventory risk. Does that clarify what we are doing?
Yes, absolutely, fully. Thank you.
Yeah, and in the next stage for RF Enterprises is that these are watches that are not Swiss made typically. So we can bring in kits into India, assemble in India, and then sell, and then add even greater margin over there. Because these are typically non-Swiss made watches. Like a Maserati watch is not a Swiss made watch.
Right. Got that. Yeah. Thank you so much for answering.
It has a massive potential if we do it right.
Sure. Thank you.
Thank you. The next question is on the line of Hardik Doshi from White Whale Partners. Please go ahead.
Yeah. So just, following up on my previous question, I just want to understand in terms of the competitive advantage, right? For all these, I mean, you mentioned earlier that a lot of these brands were looking to go exclusive and they were already here on a non-exclusive basis. I just want to understand the thought process of why they would want to go exclusive and what are the advantages that they have.
Right, that's a very good question. Like what happens is if you have a fragmented distribution system, right, what ends up happening is that no one is being able to invest behind the brand. If the brand doesn't want to invest largely in India, the others are not able to invest also because there is discounting pressure. Each one is discounting. So it becomes important to nobody. So what we went and said is that whatever you are investing, we'll invest 4 times the amount, right? Whatever was your subsidiary margin, you give that to us. We will invest, but then we don't want anybody else to be distributing. Then it becomes exclusively with us. By doing that, we are able to reduce the discounting, right? We are able to put in money into marketing. We are able to use all our data that we get from the website to do pinpoint marketing, create content behind that. So what ends up happening for every brand that has become exclusive for us, they are able to remove their fixed costs of working in India because we do it for them. Secondly, we have the fact that for every one of them, they have seen a sales increase and a profit increase, both for the retailer and for the brand themselves. Because here, let's say one brand manager will manage 5 to 8 brands. Over there, you have, if a brand wants to enter India themselves and work through 10 partners, they will need 8 people to do it. They don't have customer data, so they spend crores on marketing, whereas we have customer data, we can reach out to customers at a fraction of that cost. So therefore, it makes it profitable for each one. It's basically lesser partners, greater partnership, and that's more profitable, and that's happening world over, that people are choosing one partner in every region.
Right, understood. Yeah, my second question was on the stores. You have about 60 stores right now across 23 cities. But if I was just look at the top, let's say 5 or 8 metros, how many in the top 5 cities, what would be the number of stores and what would be a percentage of sales of this?
Top 2 cities would be Delhi, Mumbai.
Yeah, top 2 cities are Delhi, Mumbai. Delhi has 9 stores right now. Mumbai has Mumbai is kitne?
Mumbai would be somewhere 10.
Mumbai has about 10 stores. Look, I think you can go to the website and we will have that detail in the website.
Delhi NCR 14, Mumbai 10.
Yeah, 14 in Delhi, 10 in Mumbai. Right now, obviously the metros are a large percentage. I don't have the exact percentage, but is a large percentage of our turnover. But the new cities, the tier 2 cities, are starting to perform very well, and that's why we are confident of growth over there.
Would you say, like in, for example, Delhi and Mumbai, you largely kind of saturated in your presence, because if you have like 10, 15 cities, you're pretty much covering.
You say, sorry, what is that? Would I say, you'll have to repeat that?
Saturated your presence because,
No, not at all. Not at all. There is a lot of growth possible. Like I tell you right now, in Noida, we have only one store, which is 700 square feet. Noida itself, we could easily open 2,000 square feet in Noida. Similarly, in Mumbai, in North Mumbai, we don't have anything. In Calcutta, we have only one store. In Hyderabad, we have one store. In Chennai, we have 3 stores. We need more in Chennai as well. There's definitely, just because of the number of brands that want to work with us, we will need to open more stores. More and more brands there's a list of 30 brands today that want to work exclusively with us. We have said no to these brands because we don't have space within our stores, even in the city. Like Hyderabad, we need another store, just not because we can't do store from not because we can't do more sales from that store, or people aren't willing to come to that store. There's physically no more space left in the store to add the brands.
Okay, got it.
Yeah.
Right. And just one last question from me is,
Mr. Doshi, may we request that you return to the question queue?
Sure.
Thank you, sir. The next question is from the line of Shivam Shah from Smart Sync Services. Please go ahead.
Hi. Just wanted to ask, are we facing any challenges due to the Red Sea crisis?
In terms of furniture, yes, which is what has delayed some of our store opening, but not in terms of watches, because we fly in the watches. There was a couple of shipments that were delayed. Maybe we lost sales of 1.5-2 crores, but that will come in this quarter, so it's okay.
Okay, thanks.
Yeah.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, hi. Thanks for the follow-up opportunity. Pranav, you have very clearly sort of charted out top line and margin expectations for Fair Value. I just wanted to check up on the operating model for this. How you initially mentioned that you people are setting up a team in Switzerland. If you could comment on the capital intensity, etc., that will be required to pursue this growth outlook, it will be really helpful.
Devanshu, Ritesh. So Devanshu, it's very early to mention about the capital intensity, but we are regularly working and looking into that, and whatever is needed, we are very sufficient to do that. So you will see, so whenever any development will come, we'll definitely do the necessary disclosure.
Got it, Hitesh. Thanks for taking my question.
Thank you. The next question is on the line of Rahul Agarwal from InCred Equities. Please go ahead.
Yeah, thanks for the follow-up. Pranav, one question on the certified pre-owned. What's the road to to really build this to scale? Let's say $100 million top line. I understand there's competition and it's all informal, but I just want to understand your plans ahead. Over the next 5 years.
To be honest, Rahul, I don't think that the biggest challenges lie in making sure that we have the compliance and the ERP setup network and the after sales service, in this case, the before sales service network that needs to be put up to be able to make sure that the watches are completely restored properly and being given. It's also a question, to be honest, on where our priority has been there. I believe that the opportunity in the new market is also exploding at the same time. We've been sort of more busy with getting the next 25 boutiques rolled out. I believe that the next 2 years are very important to take a pole position in the new watch area, because whoever takes the position in the next 2 years, you see, once you get to 100 stores or 125 stores, most brands will want to work with you, and it's very, very, very challenging then for anyone else to compete with us. Whereas in pre-owned, we will have the time to be able to expand. So right now, the next 2 years, we've just been very focused on making sure we get the pole position and build the network of the stores, and then pre-owned will catch up automatically. Right now, as I said, my number one focus is to make sure that over the next 2 years, whoever becomes the king in the next 2 years, which is good, Ethos is clearly in the lead, will have a pole position in Ethos for the next in India in watches for the next 25 years. At that stage, to bring pre-owned up will be fairly simpler. At this point of time, I'm just going to say this, that I'm fairly confident on our growth on pre-owned. I don't see major challenges. Compliance and making sure people's compliance has been the biggest challenge till now. Because, for example, we don't take watches that are not smuggled in. We need an affidavit. We don't pay in cash. We pay only in these things. That has been a bit of the challenge, but the biggest challenge is to make sure we get enough watchmakers to restore the watch. We are doing that now. We have 17 watchmakers now in place. The next service center in South India will allow us to bring in more regional. We're doing it in South India so that we can get more watchmakers there as well, and that will continue to help us to grow the business.
Get it. And second was on margins, the gross margins. You explained a bit of it in terms of some 2 crore impact, and obviously the CHF INR has been crazy, I understand.
That is only the reinstatement and remittance loss. The margin loss was greater, because if you dial back 15 months ago, right, 15 months ago the Swiss franc was about 80 rupees. Right now it started to move from then it moved to 80 to 85, then it took 1 year to bring everybody from 80 to even 85, 88, 89, 90 rupees of pricing. Then in the last quarter it moved from 90 and it ended up at 98 rupees, right? So whatever, all the 1 year of work of getting everybody's prices up to 90, from 80 to 90, it took about 12 to 14 months to do that. But in the last 2 months it moved from 90 to 99. Now it's gone down back to 94. But for that quarter, we had a margin loss of about 1.5%.
Right. So then what's the way ahead? Now the pricing happens, I think, once a year, right? So how do we cover this?
Yeah, pricing is happening. So right now, most of it is, you see, most brands are taking the price increase now as we speak. If the price remains at about 95 rupees, right, we will have the margins that are there. Otherwise, we will have, if it goes to 105, then it will be similar to last year. So one has to see. But typically, over the last 20 years, we've seen 4% devaluation of the rupee to the Swiss franc. We've never seen like 12%. So that's the...
Yes. No, what I was asking was this 95 will get covered till what time? Forget about 105, nobody knows that.
Yeah.
In next 2 quarters.
Next two quarter, matlab already by April we should have it, yeah.
Okay, perfect. All right. Thank you so much. All the best.
That sort of help. I know it's a little bit of a tough one to answer.
Thank you. The next question is on the line of Omkar from Shree Investments. Please go ahead.
Yeah. First question is on what kind of trajectory you are looking for the average selling price for a couple of years, and the second question is on generally how long is the brand association of yours with a particular brand, which has been the longest serving brand you have been associated with? Those are the two questions.
It's hard to answer on the basis of average selling price. It's been going up and we expect it to go up, but not at the same rate at which it has been going up. That's all I can say, because a lot is dependent upon what is the inflation in Europe and what is the rupee devaluation. These two are important factors to decide average selling price. Our mix is generally going up. We always aim to upsell, but there are too many factors in play to be able to give an average selling price. That's the reality of the situation. Now coming to your next question on brand relationships. Our brand relationships are very old. In fact, we probably, out of 60 brands that we are operating today, we would have only ended relationships with about 7, 8, unless we leave a price point. We barely ever end a relationship. Many of the brands that were there on day one from Ethos are active and working with us even today. And most of the brands that were there on day one are still active and working with us.
Okay, thank you very much.
Thank you. The next question is on the line of Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, thank you for taking my follow-on. Two quick questions. One is, you mentioned that you have about, let's say, close to 20% market share and you want to get up to 40-45%.
Hardik, your voice is breaking. Can you please repeat?
Yeah. You mentioned that you have about a 20% plus market
sorry
share and you
to
want to go
interrupt, Hardik. Sir, your voice is breaking up.
Can you hear me clearly?
So slightly.
Hello?
Yeah, we can hear you. Just go ahead. Just go ahead with your question.
Yeah. You talked about having 20% market share that you're looking to take up to 40-45%. I'm just wondering, globally, if you look at, more developed markets like the US or then even China, are there examples of, companies that have got this first mover advantage and built on and dominated the world?
USA and China are very good examples, but you have to look at, let's say, where you have, for example, Southeast Asia or Middle East, where you have Siddiqui or Hourglass. Those are more important because in USA and China, no one really had first mover advantage. There were a lot of them that were there from day one. So there's a very big difference. But if you look at Siddiqui in Middle East, or you look at Hourglass in Southeast Asia, like Singapore, Malaysia, you'll see similar examples.
Got it. Okay.
Just a question about the 40% you talked about. We have never mentioned any number. What we can say that
over the next 10 years.
We have 20% and we are aiming for a larger market share over the period.
Okay. And then this last question is, when I look at, again, you take Dubai or the Southeast Asian market, what is the pre-owned watches market size as a percentage of the, the watch retail market size?
About 35%.
35%.
Expected to equal it by 2030. By most reports show that by 2030 it will start to be as big as the.
Got it. Okay, thanks so much.
Thank you.
Thank you. Ladies and gentlemen, we'll be taking the last question. That is on the line of Ajay Kumar Surya from Nivshai. Please go ahead.
Thank you for the opportunity and congratulations on a very good set of numbers. Sir, my question is more on the book side. So we had this promoter selling. So can I know any particular reason behind this?
I don't think that we need to answer that question here. It's KDDL is selling, and KDDL had opportunities to reward its shareholder and other opportunities, so therefore they took that decision.
No worries. So, and my next question is on, sir, in February, the CFO is resigning. So, have we found who will be taking over the position? And
We've already announced today.
And yes, we found someone who's very capable. First of all, Ritesh is leaving, but he will be in touch with us, and he served the company extremely well, and we are parting on very good terms. And we wish him very well for the future. And at the same time, we have someone joining us. That person has been identified, and I think it's been announced.
It is announced
today in the disclosure list. It will be there.
Okay. All the very best for the future.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments.
Thank you, everyone. I hope we have been able to answer all your questions satisfactorily. However, if you need any further clarifications or want to know more about the company, please contact the SGA team, our investor relations advisors. Thank you. Have a good evening, and Jai Hind.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Ethos Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.